Decades of a constant credit bull run had created an out-of-control credit market. The entire world economy became built on Eurodollar lending and the constant refinancing of debt. This bull market for loans allowed credit standards to spiral out of control. Banks all across the world were rehypothecating dollars, and not only as loans and bonds. An enormous market for credit derivatives had formed, allowing people to make bets on bets on bets on credit. It was unreal, surreal, and absolutely enormous. Banks would make loans completely outside of economic reality and feel confident that it would all work out, as constantly dropping rates would keep duration working in their favor. And even if a loan didn't work out, new debt securities allowed loans to be bundled together and sold off as one big security. Credit rating agencies would rate pools of mortgage loans as being of the highest credit standard, as if they didn't give a security the highest rating possible, then the issuer could simply go to a new rating agency and get a rating there. Enormous pools of auto loans, home mortgages, personal loans, corporate loans, any credit pool you can imagine were being proliferated wildly in the markets, all with investors being led to believe that they were of the utmost high quality. People would trade swaps, futures, options, taking enormous levered positions on these loans, all while the Eurodollar market fueled an enormous boom across the world, pulling dollars out of thin air. During the Clinton administration, the government had imposed affordable housing targets and quotas on government-sponsored entities like Fannie Mae and Freddie Mac. Banks began to become under pressure, being told to make more mortgage loans to get people, particularly the black population, into homes. However, with lower credit scores, the banks would either need to lend at a very high interest rate in order to get that done, or come up with something else. And they chose to use these credit securities in order to get it done. Lend to people with low creditworthiness at a rate far below what is a reasonable compensation for credit risk, and then sell them off in one big pool into the open market. So the idea went that it was an enormous pool of mortgages. People always pay their mortgages, so even if a few here or there don't get paid, the security is still sound because there are so many mortgages backing it. This would allow the housing market of the United States to go on a tear. People began buying up homes left and right, far beyond what was reasonable for them to afford, all because they could access cheap credit. This credit bull market was now touching the consumer. Meanwhile, the Eurodollar banks were making enormous corporate loans around the world, particularly in China, where they were attempting to fuel an economic boom in the recently opened up economy. The entire world was getting built off of mispriced credit and Eurodollars created out of nothing and rehypothecated upon that. At some point around 2006, this credit system began to break down. Interest rate increases in the United States would begin to manifest in a decline in housing prices. People with floating rate debt had more difficulty paying back their mortgages, while bad loans that were collateralized by American homes suddenly became a whole lot more concerning, as the value of that collateral was suddenly dropping. Much has been talked about mortgage-backed securities and the housing market of the early 2000s, but the entire global economy was built in the same way. It was built on the Eurodollar system, with artificially low rates constantly dropping, constant rehypothecation of factitious dollars, and a gargantuan derivative market that had completely detached itself from economic reality. So when interest rates began to rise in the United States, the enormous mortgage portfolios of American and foreign banks were hit extremely hard. But more broadly, the entire credit system of the whole planet would be affected, because the Eurodollar system is so sensitive to the interest rates of the United States. As interest rates rose in America, the demands for dollars that Eurodollar banks had would be put under exacerbated pressure, particularly as those credit derivatives would amplify everything. LIBOR rose sharply, and that in turn would feed back into the United States as American lenders would benchmark their loans to LIBOR. This would hit floating rate debt and refinancing, further hurting the American economy and making it more and more difficult for borrowers to pay back their debt. Just a constant vicious cycle, obliterating credit portfolios. In February 2007, HSBC would announce significant losses in their mortgage security portfolio. And in April 2007, New Century Financial, a major subprime lender, would file for bankruptcy. In June, two Bear Stearns hedge funds with very large positions in these credit securities would announce massive losses. Bear Stearns would liquidate these hedge funds the following month. In August 2007, BNP Paribas would freeze redemptions on 3 funds of theirs due to illiquid mortgage-backed security exposure. In September, the UK bank Northern Rock would experience a bank run. It was facing a liquidity crisis and appealed to the Bank of England for emergency help. In October, UBS and Citigroup would announce enormous losses. By this point, the governments of the world became extremely concerned. They could tell that this was not a mere financial issue, but could spell profound systemic collapse. In December, the Bush administration would announce a plan to help homeowners who were facing foreclosure. And the following month, January 2008, the Fed would cut interest rates 75 basis points, the largest single rate cut in the United States in 25 years. Bank of America would agree to buy Countrywide Financial, the largest mortgage lender in the United States. In February, Northern Rock would be taken under state ownership in the United Kingdom. JP Morgan would announce that it would be buying Bear Stearns, and in July, regulators would seize IndyMac. Yet it would be in September of 2008 where the emergency moves would pick up rapidly. The federal government would take over Fannie Mae and Freddie Mac, pledging $200 billion in government support. Lehman Brothers would file for bankruptcy protection. The government would bail out AIG with an $85 billion loan. Warren Buffett would step in and pledge guarantees to corporate debt. Goldman Sachs and Morgan Stanley would convert to bank holding companies in order to access Fed lending facilities. And the Office of Thrift Supervision would close Washington Mutual, the largest bank failure in United States history. Around the world, in Britain, the United States, and Europe in particular, the entire financial system was melting down. It had become clear that the credit system of constantly artificially dropping rates, the rehypothecation of Eurodollars, meaningless credit ratings, and an absolutely gargantuan behemoth of a credit derivative market had created an enormous amount of theoretical wealth that was completely detached from the economic reality of the world. And now that reality was catching up. In October of 2008, the Emergency Economic Stabilization Act would be passed, and the Troubled Asset Relief Program initiated. Beginning on October 6th, the stock market would experience its worst week in 75 years. On the 14th, the U.S. Treasury would announce a $250 billion liquidity injection into 9 major U.S. banks. TARP, the Troubled Asset Relief Program, was presented to the American public as a necessary measure in order to save systemically important institutions from collapse, that this bailout was necessary, or else the financial system of the United States would be far worse, with dire implications for the American public. Yet the federal government ensured that enormous amounts of liquidity were made available to the Federal Reserve, and the Eurodollar banks, far more sensitive to strains in US dollar credit supply, were in much worse shape than the American banks. The Fed would open its lending facilities, giving favorable loans to banks around the world, keeping the Eurodollar system alive. $1 trillion to Barclays, $1 trillion to BNP Paribas, $772 billion to Credit Suisse, $711 to Deutsche Bank, $628 to Royal Bank of Scotland, $425 to UBS. The United States, through very minimal degrees of separation, bailed out the world, and bailed out the bankers who ran it. But of course this could never be presented to the public. It's one thing to speak about bailing out your own banks for your own economy, But bailing out a German bank? A British bank? The American people would never tolerate that. So it was done quietly and indirectly. Yet all the same, the response to the financial crisis of 2008 was an enormous liquidity injection into the global Eurodollar lending system, keeping the international banks alive when they shouldn't even exist. The Federal Reserve would lower its target range all the way down to 0 to 0.25%, creating an era of nearly free money. If there had been an absolute mania before, then near zero interest rates were a whole new dimension. It's really quite stunning to think that in order to prop up the international banking web, US Federal Reserve rates would have to be near 0%. It would create an entirely artificial financial system, generating impossibly free money, just hoping that it could limp along long enough to rebuild something. In February 2009, Obama would announce a $787 billion stimulus in the American Recovery and Reinvestment Act. The following year, the Dodd-Frank Act would impose aggressive regulation on the financial sector. The financial sector was to be placed in a box, while the United States became geared to propping up the banks of London and Europe, allowing them to continue their Eurodollar lending system that was eroding the purchasing power of Americans. If this were ever disclosed, it would be met with extreme hostility. So the story was always kept at, some bad mortgage loans were made, but we had to bail them out, never daring to discuss the much deeper problem. All the same, there would be an enormous backlash from the American public, and from the publics across Europe. The Occupy movement would begin, with large protest demonstrations in Wall Street. They were irate that so many people would have their homes foreclosed and be laid off from their jobs, while the financiers who had made those mistakes in the first place, causing it all to happen, seemed to have very little consequences. Of course, by and large, these protesters didn't understand what was happening. They couldn't. The arcane nature of the global credit derivative market is so absurd, and it is never spoken about. Yet they caught a glimpse of something. They knew that something had to be wrong. And even if they couldn't identify quite what it was or how it worked, something changed in America. People knew that the financial system was doing something it shouldn't. Around the same time, the Tea Party movement would begin. They wanted a smaller government, less spending. They often had a certain libertarian ethos. It was the beginning of a new wave of right-wing populists. They stood in stark opposition to the neocons who had dominated the Republican Party during the Bush administration. Instead of being war hawks who loved the intelligent state, they wanted America out of wars, and the government shrunk. They distrusted the government, and they felt betrayed. The financial crisis of 2008 was a real strong turning point in the American psyche, even if people couldn't quite articulate it and didn't really know what was wrong. Everyone knew that something was wrong, and that the world's leaders were not behaving in the best interests of their people. So, those bankers who had gone absolutely wild with credit, those bankers who had lived off the Eurodollar system for decades, what did they do when they saw that their system had come crumbling down? They were faced with a few options. They could align their financial firms with economic reality. It would be difficult, it would be messy, and they wouldn't make as much money, but it could last in the long run. Or they could do something else. With the near $0 interest rates, if their system was doomed anyway, why not take it all the way? There was no more prosperity to grow in the West, nothing more that could be extracted. They turned their attention to Asia, particularly China and India, and to the Middle East. With low interest rates, they would build the most fantastical credit derivative market in the entire world. Build the completely detached Eurodollar market into something far beyond what it had ever been. Use that rehypothecated, imaginary money to secure the assets of the West and move them out. Go for broke, print a whole bunch of money, take the assets, and leave. It became clear that their empires in Europe were ending, that the sovereign debt situation of Europe was unsustainable, and that they had already extracted far too much from Europe and Britain in particular. If there was nothing else to be gained, why wouldn't you print up fake money, grab the last of it, and let it all burn while you abscond to somewhere far away? The race was on, and the post-2008 world was going to get a whole lot darker.